सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this week's Macro Sutra. I'm Yuthika Bhargava, and today we will talk about some big themes that can impact economy in 2024. One big theme is that of global uncertainty with all the wars continuing, and another big theme is that of resilient Indian economy. To discuss this with us and some more themes, we have with us Radhika Pandey, Associate Professor at National Institute of Public Finance and Policy. Hi Radhika.
Hi.
Before we delve into what 2024 holds for us, can you give us a bit of a recap, a quick recap of how 2023 was for Indian economy? What were the hits and misses?
So if you look at 2023, one of the biggest hit was the resilience of the Indian economy. So if we see the GDP growth, GDP for the first quarter came in at 7.8%, then GDP for the second quarter came in at 7.6%. So the first half of the year, we got a GDP growth of 7.7%. And even now, if we look at the some of the key high frequency indicators, we see that the growth momentum is continuing amidst the global uncertainty, the geopolitical headwinds that we are seeing. So definitely one of the major highlight of this year has been the resilience of the economy. The other is also that inflation has been very high. So in terms of misses, if we say, or if we talk about one of the key challenges, this year we saw inflation elevated, and in July particularly, inflation surged to 7.4%. And since then it came down, and in number of months we saw inflation was even above the upper threshold of 6%. So on the one side we had a resilient economy, on the other side we had high inflation. So that was another point. But on the external front, what we see is that, our current account deficit has been quite moderate. So even though our, oil imports in volume terms surged, but if we talk in terms of the impact of oil imports on our balance of payment, it did not have a very material impact. So our balance of payment in terms of our current account deficit was quite contained in this year. If we say that, for this year, we are likely to have a current account deficit of 1.6 to 1.7% of GDP, which is quite encouraging. Anything which is less than 2% of GDP is encouraging amidst this global challenging environment. And another key highlight is about the financial markets. We saw huge swings in financial markets in India's financial markets, mainly because of whatever we saw in other countries. In the early part of the year, we saw a banking crisis brewing in the US, a slowdown in China, that impacting India's financial markets, and then yields, the US dollar index coming down, that having a positive impact on the markets. Foreign portfolio investors have been net buyers, but the main positive point has been that the domestic investors have provided cushion to the financial markets. So volatility has not been that much as would have been if the cushion would not have been provided by domestic markets. So I would say on the one side we had a resilient domestic economy supported by urban consumption, supported by high government capex, because the emphasis on capital investment continued in this year as well, what we have seen since post-COVID, and that is not only by the central government but also by the states. So that has given some resilience. Construction sector has done very well in this year. But on the other side, challenges have been in terms of high inflation, the geopolitical conflicts that had an impact on our goods exports. Goods exports suffered due to that. But overall, our balance of payments have been quite comfortable this year.
Coming to 2024, we enter 2024 amid this geopolitical uncertainty. It is also an election year, and not just in India, but many major economies of the world. What impact do you think this will have on Indian economy? Will we continue the momentum that we have, and also on the world economy?
So if we first talk about the world economy, the major benchmark or, the indication that we can get is through the projections that are released by the standard setting organization. The International Monetary Fund came up with global growth projections. So what we have seen is that global growth is likely to slow down further in 2024. In 2023, global growth is expected to be 3% GDP growth, whereas next year it's expected to even be lower at 2.9%. And that is understandable given the sustained rate hikes that we've seen by global central banks. Across economies, we have seen central banks have been aggressively increasing interest rates after COVID to curtail inflation, to control inflation, and that will start showing its impact now, because now we've seen that inflation is coming down, but at the same time the demand is also slowing down. So we will see the impact of the sustained interest rate hikes on global economic growth, and that explains the lower growth projection for the global economy as a whole in 2024. Of course, the slowdown will be led by advanced economies, because we have seen more aggressive rate hikes by advanced economies, because they started with a very huge fiscal expansion. So that will now feel the pinch when interest rates have been continued increasing. So global, we are already seeing in European Union there, it's already on the brink of recession. So EU GDP for 2 consecutive quarters, we have seen that the European Union GDP has contracted. Even in the US, we are seeing some mixed signals of slowdown, though they are not consistent. It may have a soft landing, but at least in some economies, we are seeing that there are indications of growth slowing down. So that is for the global economy. For India, I think the growth momentum will continue if it is powered by urban consumption. That is what we are seeing. And also if there are certain more factors, for example, government capex continues, but at the same time, if private investment picks up, that will have a major impact on, continuation of the growth momentum. But as of now, if we see, yes, growth will see its momentum, though not at the same rate. Because for this financial year, India's economic growth is now projected at 7%, because we had such healthy growth in the first 2 quarters. For now, the full financial year, we expect India's economic growth at 7%. But for the next financial year, even India's economic growth is expected to slow down to somewhere between 6.3 to 6.5%.
Okay. And another big theme has been high inflation and high interest rates, that too in India as well as globally. In 2024, do you see this trend continuing?
What we see now, so if we look at the inflation trajectories of these economies, we look at the inflation trajectories of US, European Union, UK, what we've seen is that there has been a sustained easing of inflation. The inflation was as high as 10% in EU in November 2022. And now in November 2023, we have seen inflation is 2.4%. Similarly, for US, inflation has been consistently falling, and the latest number is 3.1%. So inflation is slowly inching towards the target, though it's still above their inflation target, which is 2%. But there is a sustained deceleration in inflation in all these advanced economies, which has led the central banks to become more dovish in their stance. So much so that, for example, the US Federal Reserve has now indicated in its latest policy that they will start cutting rates next year. And if we look at their, summary of economic projection, what they have indicated is that next year they are going to cut rates by 75 basis points. So there could be like 325 basis points reduction in interest rates in the coming year. So definitely for advanced economies, we can expect a more faster move towards interest rate cutting, also because the growth is slowing down. So now they will have to provide that support in the form of interest rate cuts. And maybe in this direction, the EU central bank will take a lead, because they are already on the brink of recession. So maybe EU central bank is the first advanced economy central bank to start cutting interest rates, followed by US and then followed by UK. India's central bank will take this decision much later because we are still above the inflation target of 4%, and here our inflation is still driven by food inflation. So I think RBI will be not be in a hurry to cut the interest rate, but we can expect, if there are no fresh shocks to inflation, if there is no fresh war which can further likely elevate price pressures, we could see some interest rate cuts in the second half of next year. But the interest rate cuts in India will be much shallower as compared to interest rate cuts in advanced economies.
You also talked about the growth of Indian economy. So which will be the sectors or some industries from where this growth will come from?
So what we saw in the second quarter, we can take some lead from there. If we look from COVID time, what happened that during the COVID time, the services sector suffered a lot. And then when COVID started to recede, services sector rebounded. So 2021, 2022, we saw services sector showing a sharper pace of growth. But now what we are seeing is that services sector have started to normalize. So we don't see that sharp pace of growth that we saw last year. So now the services sector have started to normalize, and therefore we can expect that, it's the goods and not the services that will propel the economy forward. Of course, that will require certain reform, that will require the private investment to take the lead, because as you rightly mentioned, this is going to be election year. So it may well be that government is not able to have the same kind of capex push that we saw last year or last to last year. So maybe there is some moderation in government capex, and then the private capex will have to pick up the pace, and then if that happens, then manufacturing sector will be the key driver of growth given the other reform that the government has undertaken. So we are seeing a normalization. I would not say slow down in services growth, but now it's kind of normalizing towards pre-COVID levels after seeing a brisk pace of growth after COVID, because during COVID services sector were impacted, then it rebounded with a bang, and now services sector are normalizing. So we should see again a shift in the momentum of growth from services to goods.
But do we see private investments actually coming back? Like, why have they been slow, and this year can we expect them coming back strongly?
So private investment has been slow mainly because of global uncertainty. We need a stable environment for investments to flourish. That is very important. That is one reason. Even though if we look at the balance sheets of private companies, if we look at their profitability is high. It's been in double digits in the first 2 quarters of this financial year. If we look at operating profits, because there has been cost reduction, commodity prices have come down in this financial year, so that has resulted in improved profits. So financial health of companies are much better. They are also leveraged they are also deleveraged in the sense that they are not under any debt pressure. Interest coverage ratio is healthy. The debt equity ratio is low. So it's not that they are under any debt pressure that, they have to save to repay the debt. So they are they are in a good position to kickstart the investment cycle. And that will happen only if there is less of global uncertainty, and also domestically also if there is political stability, that will give a momentum to private investment. As of now, what we are seeing is mixed signals. If we look at capacity utilization in the manufacturing sector, it has picked up. We have data till April to June of this financial year. But the RBI bulletin of December is talking about the capacity utilization of subsequent quarters also. Though they don't give the numbers, but they are saying that capacity utilization has further improved. So, which is a good thing that, if your capacity is improving, then you will do fresh investments. If the existing capacity is idle, then you will not be able to do fresh investments. So, conditions are ripe for kickstarting the private investment cycle. But at the same time, if we look at some of the other data sets, we look at the new projects announced, they haven't picked up at a very healthy pace. So as of now, the signals are mixed. On the one side, we see capacity utilization, which is slowly and gradually picking up. But on the other side, if we see the announcements of new projects being made by the private sector, they have not picked up at a very sustained pace. So we need to see what happens, but definitely we should see some moderation in government capex, because that they will have to do if they have to stick to the aggressive fiscal consolidation roadmap. They have to meet the 4.5% of GDP fiscal deficit target by 25-26. That will require some moderation in government capex, but then the private sector investment will have to take the investment forward.
Radhika, I'll take an audience question at this point. Sankalp is asking that 50% of India's population is still trapped, contributing just 20% of our GDP. Despite tall strides, a large part of our population is a laggard. Despite being at only 4.2% of GDP, Europe's villages contribute over $2 trillion through agriculture. That's half of India's GDP. The farm laws are dead in water, but in your view, can India's agriculture grow beyond a certain point with the current framework?
So with the agriculture, definitely the farm laws could have provided an impetus, but even without the ambit of farm laws, certain reforms can be initiated. We've talked about those earlier also, in terms of improving the logistics, improving the farm infrastructure, improving the storage facilities. All those things are very important to reduce the dependence on adverse weather events, and to somehow minimize the violent fluctuations in agri prices that we are seeing. But this time around, as I mentioned earlier also, we have challenges which extend much beyond the ambit of farm laws, and which are something which even the farm laws would not have been able to address, which is the unfavorable weather events that we are seeing, the El Nino impact that has been playing around not only in India but globally, and that is something that is going to be a challenge for next year as well. We saw this year food inflation remained elevated, and even next year is likely to be, because the wheat production, firstly the rice production is likely to be lower as compared to last year as per the agricultural estimates. Even the wheat production could suffer because there is less of soil moisture, and in the first half also El Nino impact may play out. That could have an impact, and this is at a time when we are already seeing shortage in our state warehouses. We don't have that much of stock, because government has been offloading the stock in the open markets to control prices. So our buffer stocks are also at a 7-year low, and we may come to a situation in April that we may have to import wheat. We are the second largest producer of wheat globally, but we may come to a situation where we would have to import wheat because our stocks are going down because of offloading in the open market. Even now we are doing that to control prices, to augment the domestic supply of wheat. So that is one major challenge that played out in 2023, and that will play out in 2024 as well. So agriculture is going to face challenges. Even in the second quarter, we saw agricultural growth just as 1%, and that is expected to be the case even at least in the first half of 2024, that agricultural growth could remain under pressure, and that will have an impact on rural income, that will have an impact on rural demand in the next year as well.
Radhika, you talked about Indian economy again, and how we expect to grow, but maybe at a slightly slower pace than this year. So what are these major headwinds that you see for the Indian economy?
So see, one headwind is definitely the global uncertainty, as we pointed out that, the global growth will slow down next year even more, and that will impact our goods exports. So the transmission of exports and its impact on growth could be challenging, but what is crucial to see is the cushion that will be provided by services exports, because services exports have been resilient this year, and if they continue to be resilient next year as well, then overall our external balance of payments position will look comfortable, our trade deficit will look comfortable, it won't be a cause for concern. So while goods exports are definitely going to be under pressure, they could remain subdued, but on the other side, services exports will have to be able to cushion the impact of the decline in goods export. And this is because, as I said, US is one of our major trading partners. So if US economy slows down, if EU slows down, that will have an impact on our exports, because the share of emerging economies in our exports has been falling. It's the share of the US that has risen. So if global growth slows down, so that will have an impact on goods exports, though services have been quite resilient. So that is one challenge, global slowdown. The second challenge is food inflation. So, and the impact on rural demand, because food inflation is likely to remain elevated. We don't see any signs of immediate easing of either cereal prices or pulses prices, at least in the initial months of 2024, and that will have an impact on rural demand. So while urban demand is likely to remain strong, but rural demand is going to suffer. The third point is about the bank credit. So what we have seen is till now, and even yesterday, the Reserve Bank of India released a report on trend and progress of banking in India, where we are seeing that banks' NPAs are at a 10-year low. So banks' balance sheets are good, but going forward now challenges will emerge, because there is going to be a repricing of loans and deposits, because now banks are grappling for funds. If they have to advance credit, they will have to advance higher rates to deposits. We saw State Bank of India raising its deposit rate. So if they start offering higher rates, the net interest margin is going to come under pressure. Their profitability is going to come under pressure, though it's not going to fall abruptly, but the kind of record profitability that we saw in this financial year, we might not see in the next financial year. So that will have an impact on bank credit, because bank credit this year was 16 to 17%. If we exclude the impact of merger, and if we include the impact of HDFC merger, bank credit was even higher at 18 to 19%. Next year, it may slow down to 12 to 13%, mainly because of tight liquidity conditions, mainly because of agriculture not taking so much of loan. But the good part is that, the demand from households will continue. Retail loans will continue to grow at brisk pace, because we are seeing a lot of demand for housing, real estate, construction. So that is something that is likely to play in the coming year as well. So while the overall bank credit growth may moderate a bit, but the retail credit growth will hold up, and that will provide support to the overall banking credit.
Thank you so much, Radhika. That is all we have for today. Thank you so much for joining us, and wish you all a very happy new year.